I spent over 100 hours studying, backtesting, basically trying to figure out how to actually trade V75, one of the most volatile synthetic indices on Deriv. This is the video I'm showing the exact strategy that finally clicked, plus how to trade it step by step. I'll start from the scratch so that even if you are new to trading on Deriv, this video will make a lot of sense to you. I'll cover what synthetic indices are, how they work, why some traders prefer them over Forex, which asset to focus on and which to totally avoid, how to calculate your trade size using Deriv's specific calculator, how to set up and fund your accounts, and the strategy that I found to finally bring in the dough. This is a video every beginner needs before placing their first trade on Deriv, and it's also going to help long-term traders to simplify their process. Now, because my Deriv affiliate link is in the description of this video, I'm required to share this disclaimer. Deriv offers complex derivatives like options and CFDs, and trading them involves real risk. You can lose some or even all the money you invest, especially if you trade with borrowed funds. And if currency conversion is involved, exchange rates can affect your profit or loss. Please make sure you understand this risk before trading and never use money you cannot afford to lose. All right, with that out of the way, what is Deriv? Deriv is an online trading platform that allows you to trade a wide range of financial products, including Forex, commodities, stocks, options, and the most popular offering, synthetic indices. They started about 26 years ago as binary.com, and now they've grown into one of the biggest retail platforms globally. Over 3 million traders, especially in Africa, Asia, and Eastern Europe, use Deriv every single day. Deriv has won a couple of awards even this year, 2025. But what really sets Deriv apart is this. They created their own market called synthetic indices. You can trade this amongst other offerings on MT5, DTrader, Deriv Go, Deriv Bot for automated trading, and Deriv C Trader for advanced manual, algorithmic, and copy trading. Deriv is actually so simple to use that you can start with as little as $10 or try their demo account first to see if it is the right platform for you. So this is a brief history of Deriv. What this video is going to be about from this point on is synthetic indices on Deriv. Because to trade these synthetic indices, it is important you know what it is. And don't forget, I'm going to show you a strategy that actually works with a win rate of over 60% and a minimum risk reward of 3R. So what is synthetic indices? Synthetic indices are man-made financial market created by Deriv. They're not tied to or connected to real-world assets like currencies, gold, or stock. Instead, they are generated using a mathematical algorithm known as random number generator, which simulates the movement of real markets with specific volatility levels. What this means is this. They behave like real market with trends, breakouts, and retracements, but they are completely independent of global news, interest rates, or political events. And unlike Forex or stock that closes over the weekend, synthetic indices are available 24/7 every single day, so that even if you are busy on the weekdays, you can trade them on the weekends. Now, the question that I had when I first learned about synthetic indices is this. Are they not susceptible to manipulation or control by Deriv since they are synthesized? And the answer Deriv gave is that the random number generators that power synthetic indices is audited by independent third parties like iTech Labs and Ecogra to ensure fairness. Now, I haven't verified this claim. You are welcome to do that research and let me know in the comment section. What is, however, good to know is that the market behavior of these synthetic indices actually follows solid technical analysis, and that is what makes them tradable. Now, the advantage that synthetic indices have over traditional Forex that makes a lot of traders kind of prefer them is that 1, it is available 24/7. 2, you don't have to worry about fundamental news like CPI, NFP affecting price movement. 3, many of these indices follow technical analysis. 4, small accounts can grow fast if you know what you're doing. And 5, Deriv is unique in the sense that a synthetic indices is not available anywhere else. So you are not trading against banks or large institutions. That said, many of these Deriv advantages also double as disadvantage. For example, there's no real news to guide you on the general direction the market should tend to, and sometimes spikes can happen randomly on the charts, and we cannot really say the reason for that as we would in Forex or anticipate these spikes to stay away from the market. Another example is that synthetic indices are only available on Derivs, so you are stuck with Deriv even if you don't like them, and if they are not supported in your country, you cannot trade them. And 3, just the way you can grow small account fast, you can also blow your account if you don't know what you're doing. Deriv has over 60 synthetic indices grouped into about 11 categories. The most traded ones are volatility indices. They are the most popular. They mimic real market movement with fixed volatility levels ranging from V10 to V250. And I'll be showing you how to trade V75 specifically in this video. The second most popular one is the boom and crash. They move steadily, then spike upwards for boom or downwards for crash. And I will bring in a pro Deriv trader who has been trading for years to teach the strategy to trade this boom and crash. So make sure that you're subscribed and you have that bell notification on so you don't miss that particular video when it comes out. Now, other categories include the step index, range break, jump indices, hybrid, and DEX indices. I'll be making a video on some of them again, so make sure you are subscribed to this channel, have the bell on so you don't miss that. Now, the final thing I want to show you before I share the strategy for V75 is how to set up your account to take the trades. There are 5 steps to this. 1 is creating a Deriv account. 2, funding and withdrawal. It is very important you do this the right way from the right source so you don't lose your money. 3 is choosing and creating a trading account within Deriv. 4, risk calculation. Don't miss this particular one so you don't blow your account. And 5, how to actually place a trade with your chosen trading account. The first one is straightforward. Use the link in the description of this video to create a Deriv account. Using that link is actually really important because it ensures that when you request to join the private Telegram group for signals, you're going to be approved. The next one is funding and withdrawal, and it is important you get this right. I will show you. So here on the homepage, you can see I have a balance of $804. If I click on the arrow beside the deposit, this is the different wallet I have in Deriv. So we have the crypto wallet and the dollar wallet. And note that if I deposit into the crypto wallet, I can only withdraw crypto. If I deposit into dollar wallet, I can withdraw dollar or naira or any other fiat currencies. Clicking on deposit will show me different deposit options. Another way to get here is to click on this hamburger menu icon at the top left corner, then click on cashier. This brings out 4 options: deposit, withdrawal, payment agent, and transfer. Transfer is to move money between wallets and trading accounts. Payment agent is the only way you can withdraw money from dollar wallets if you are in Nigeria. However, you can deposit using several methods. So if I click on deposit, you can see I can deposit through different methods, including cards, bank transfer, e-wallet like Neteller, and alternatives like the JTIM Cash. Now, since you can only withdraw through payment agents if you're in Nigeria, you might also want to use it for your deposits. In the payment agent page, you can do deposits, you can also do withdrawal. Now, there are 2 payment agents that I've used over the years, and they have really good track record. One is Ahmed or Buhari Exchange. The second one is Chijioke of Echo Payment Solutions. So you have your contact here and just start them up. But anyways, I'll leave both their names and contacts in the description of this video. Just let them know you are from Jude to get the best rates. It is very important that you only deal with verified agents that have good track record to avoid getting scammed. Okay, now step 3 is creating a trading account. To do that, we are going to go to Traders Hub. You'll notice that there are two types of trades you can take. You have the options and CFD. We can do options in another video. What I'm interested in this video is the contract for difference. This is where you have the synthetic indices. So the type of accounts here include the standard accounts, financial STP, swap free, zero spread, and gold. All these accounts are for MT5. In other words, you need to connect them to MT5 to trade. Other ones are the Deriv C Trader and the Deriv Nakala. Both of them you can use for copy trading. To compare which account you should choose out of this, just click on compare here. It's going to show you different metrics. You can see in some of the accounts, you can trade all the instruments. In some, you cannot trade some instruments. And in some, they have better pips. Some have zero spread, and they have different specification. But to me, anyone is simply fine. But if you're trading synthetic indices, just make sure that the accounts you are choosing supports synthetic indices. By default, you're going to have the standard account, which is what I have now. But for the purpose of this video, I'm going to create a swap-free account. It also has the synthetic indices. To do that, I'm just going to click on Get here, input my password, and click on Get. Then I already have funds in my account. So I'm just going to transfer some of them here. Let me transfer $400 here. The next thing is to go to MT5 and enter these details. So just go and download MT5. Then in settings, click add new account. The server name, what you just do is to copy the Deriv SVG LLC. You click on it. For the server, I'm going to copy the second one and make sure it's the second one, server 2, yeah, which is this. And the login, I'm going to copy my login and I'll enter my Deriv password. So this is it. So on MT4 now, I now have, you can see my balance here. If I go to quotes, these are different currencies I can trade. Let me just do some house cleaning. I want to delete all of them. What I really want to trade is the volatility indices, specifically V75. I'm going to click on it and I have it here. So I can click on it and then click on trade to take this trade. Now, let's look at the strategy to trade Deriv using TradingView. But if you go to TradingView and search for, say, VIX75, you're not going to find all the Deriv instruments. So what you do is that you go to charts.deriv.com. So you will see all the Deriv instruments. Yeah, you can conduct your analysis on them on TradingView if you enjoy using TradingView. So to conduct analysis, let me just take this out so you understand the strategy I use. The strategy I use is actually pretty simple. For Deriv, I do swing trades because I see it better than doing day trades. For V75, I prefer swing trades. I've not really found success doing day trade, so I do swing trades on them. So let's look at these charts and see the trades we can take and the strategy we can use. So if I start from the 4 hours, or I can start from the 24 hours and look back. I don't look back too much. So what I do is simply this. I'm looking for demand zones. Then I'm looking for break of structure. I'm looking for, again, demand and supply zone, break of structure, and that is it. So if you look at this movement here, we have movement downward this way. We'll have a shoot upward and this. So again, let me repeat myself. I'm looking for demand zones, demand and supply zones, efficiencies and inefficiencies, fair value gap, and break of structure. So knowing demand zone already, a demand zone is not possible without a fair value gap and break of structure. Okay. So if we look back at this point on the daily time frame, I'm going to mark out this candle that formed here is a demand zone. Why is it a demand zone? Because it has a gap here. After the candle formed, we had a movement downwards, and this candle and the next candle does not overlap each other. So we'll call this an imbalance or fair value gap. This is what makes this a demand zone. So this is the zone I'm looking to take my trades from. So if you look at this, we came all the way, tapped into it, came down, broke structure, came up, and respected this demand zone again because we have a fair value gap here. Came up, came down, and this one, we didn't respect it. We shot above. But I want to look at this trade from this particular point and see the possible trades. To do that, I'm going to go straight to the 4-hour time frame. See, in the 4-hour time frame, again, this is the demand zone I marked out in the daily time frame. I can decide to refine this. I can even refine this further because this candle here, this candle before the fair value gap that broke structure to the downside is what I'm interested in. So when the market came down to that region, it rejected from there. So this is the right place to take my trade from. But we are on the 4 hours. I actually take trades from the 1-hour time frame. But what I want to actually dive into is this region. Let's look at this region. Okay. The market came up again into that same region to reject from. There are multiple opportunities to take trade here in the 1-hour time frame. That is what I want to show you now. We are having break of structure to the downside. So we'll have a break of structure to the downside. So when you have a break of structure to the downside, it means that the market is going to go up and come down again because the market is trending downwards. We have another break of structure here. You can see the market came down, broke structure, went up, and came down again. And here, what do we have? Because we broke structure here again, the market went up. You can see it didn't respect this because we have this upward movement coming from a demand zone this way. So when it got here, back here, we don't just take the trade, we still wait for another break of structure. So from this point, when it got here, I'm not going to take this trade. I'll still want a break of structure to the downside. This is where I now go to the 1-hour time frame and start looking for trades. So we had a movement up to this region, and look at this. We had a high, a low, a high, a low, a high, and a low. So at this point, this is the low that made the highest high we're having here. Once that low is broken, that is when we now certify this as a break of structure to the downside. Once this happens, I start looking for trades to take this lower. And where do I look for trades? I'm looking for trades as supply zone. Again, this is a supply zone because we have a movement downward and a fair value gap here. So the last candle before that move is my demand zone. So we have a demand zone here. We have another demand zone. I'll show you the demand zone before. This is the demand zone here. This demand zone didn't lead to any break of structure. This is the demand zone that led to this break of structure. This one. So it means that the market is going to come back into that region and go down more. So this is where I will take my very first trade by taking a short position from here, placing my stop loss here, and I can go as low as 3 hour. I can target this region. The market broke structure again this way. Since the market broke structure, this demand zone led to that break of structure. The market didn't come up here, so no problem, we'll leave it. We had another break of structure this way. This particular tiny one is also a break of structure. So where do I look to take my trade? I'm going to look up here and draw my demand zone at this point and wait for the market to come back to it. The market didn't come back to it, no problem, we'll leave it. Where do we have another break of structure at this point? So what do? I go ahead and draw my supply zone. And yes, the market came back to it. So I'll just simply, when I draw this, I'll simply place my order this way and go for at least a minimum of 3 hours, okay? Or I can simply target this low here. As a matter of fact, from here, when I took this particular trade here, I could target this low because we had a very big fair value gap here. So the market is expected actually to go and come down to as low as this. So this is another 4-hour trade. Then if you look at here, the market broke structure here again. What do? We mark out the candle before that. This is the candle, and we didn't have an entry here. It came down, it came up again. We didn't still feel this, okay, and we came down. But if you look at this, I would have actually taken this trade because I don't just only rely on the market coming down to the supply or demand zone. Sometimes the market may not get there, but there's a way to still take the trade, which is using the Fibonacci retracement tool. So I customized mine. You can actually follow the settings to customize yours. It's pretty simple. So pause the video, customize yours, and you see how it works. So let's go back and still use the Fibonacci tool to see if it's going to work for us. So from here, this demand zone, if I draw it to the low here and extend, all I'm interested in is this 705 level. If the market comes to 705 level, I can take the trade if I have a confirmation from the stochastic RSI. So let me repeat myself. If trades comes to my demand zone, I can take the trade. I don't even need confirmation from the stochastic RSI. But if the trade doesn't come to my demand or supply zone, but comes to at least the Fibonacci level, then I can take the trade if I have a confirmation from the stochastic RSI. You see what I mean? So if we mark from this zone up here to the down here and extend, looking at this low here, you can see the market came into 705. It's in my demand zone, so I don't even need this, but I'm not showing you that it still works. 705, it tapped into 705. And if you look at the stochastic RSI, once I have this cross, it's overbought. Once it must be overbought and I have the cross, it's a signal to actually take this trade. Let's go to another one that we have. If you look at this one, if we take it from here down to this particular point, the market didn't come to our 705, so I'm not bothered with this. If we look at this one that we still took, if we take it from here to the bottom, the market did come to our 705, okay, but it still tapped our demand zone, so I don't even need this Fibonacci tool and the stochastic RSI to take this trade. Let's look at this one that I said I would have taken. So if I did the same thing, I take it from here and take it all the way to this particular low, the market came to 618. Even though it gave us a stochastic RSI signal, I'm not going to take it because I'm interested in 705. It didn't come to 705. Now, the market now came all the way down. I can still mark this because if you look at this area, let me remove this first. If you look at this area, we did not have any demand zone. So it's an efficient price action. I'm not looking to put my Fibonacci tool from that point. I will still place it from the top and I'm targeting this particular low. Now, so this is the 705. I'm going to mark it out and remove the Fibonacci tool. So this is where we have the 705. This line is 705. So let's investigate this. So when it came, it was coming up. It didn't get to this point, but when it got here, this point, we had the first cross. Let me zoom in so you see. We have the very first cross around here, but the market hasn't gotten to my 705, so I'm not interested in what it's doing. Okay, but then it's crossed again. The next cross happened around here with this red candle. So this is the place I will have entered from. And you can see we had a very swift write down. If I use the risk reward ratio tool again and place this, stay around here, target this up, and even come down to this point, it's already giving me my 3R. The next one, if you look at this region, this particular region, we have an efficient price action. There is no fair value gap. The next fair value gap we have is here. So this is then a supply zone where we should take our trade from. Supply zone, because that supply zone broke this structure. So this is now where I'll be looking to take a trade from. Short position from here. Put my high here and target at least this particular point. Okay, so this gives me a 4R risk reward ratio. So once this market retraces back to this point, it should tap in and come down. Now, for the sake of spread, I might put it a little lower. Another thing I could do is to still hold my Fibonacci tool. I take it from this top to this particular low and extend. So my 705 is this particular line. So I can call it 705. So my 705. So what this is telling me is that if this market, even if it doesn't hit the demand zone, but it comes up to the 705, then I'll be looking for a signal from the stochastic RSI. It should be overbought. Then once I have the cross, I can take this signal here. So how do I place this trade? This is very important because this is where a lot of people get it wrong. I'll be using the FS Crypto Calculator. So this is it. You can get it from the Play Store and the App Store. Once you have it, you can calculate crypto, Forex, and Deriv here. So what I would do is to select V75. So that's what I'm trading. My account balance is $400. What do I want to risk in this trade? In other words, when I lose, what am I willing to lose? Let's say I want to risk 2% of my account. That is $8. If I want to risk 3%, that will be $12. In other words, when I lose $12. And for this particular trade, when I now win, I'm winning 12 times 3.92, which is $47. Again, so if I lose $12. If I win $47. So this is what this means. And this calculator helps me to actually do it right. So then on that entry, I'm going to enter my entry price, which is 86. This one here in gray, 86774.0130. And my stop loss, I'll enter 87841.1693. Then I'll just go ahead and click on calculate. So my lot size is 0.011. So what I would then do is to go to my MT5 to place the trade. Click on volatility 75 and click on trade. I'm going to use limit order and his sell limit order because I'm trying to sell this market. And what we calculated as lot size is 0.011. My entry price, the same price, 86774.01. Stop loss is 87814. My take profit is 82587.44. So I click on place. If I go to place, this pending order has been placed. All I have to do now is just to wait for this trade to play out. Now, if this trade happens to make another movement down this way that breaks structure this way, then I want to be considering this particular order block here and do this. Okay, I'll keep on doing this until the orientation change to the upside and we have a proper break of structure to the upside, and I'll then trade up. All the links you need are in the description, including the link to get into the private group. And make sure you're subscribed, because the next thing we want to talk about is boom and crash in another video. If you like this video, just hit that like button.